monetary policy is the guideline that the Federal Reserve Bank uses to set overnight lending rates. What's important about it is how monetary policy changes or is affected and how the Fed acts on it is usually based off one main determinant. There's a lot of other things that go into it, but the main one is inflation. And the bogey that the Fed is focused on for the better part of the last decade is maintaining a level of 2% inflation or less. And inflation, as we all experienced last year, went up over 8-9% at one time. They've done a pretty good job, I think, at managing it this time around and pushing it back down closer and closer to that 2% benchmark that they want to meet. Currently, inflation is tracking about 3%. Looks like it may drop below that. It may take a while longer, but the trend has definitely been moving towards this benchmark that they have of 2% on inflation. Whether or not they'll get there, I don't know. It might take a few more years of above average interest rates for what we've been used to for the last decade. So there's a direct and indirect correlation with how higher interest rates can affect the average consumer. Whether your credit card bills or mortgage bills, your car payments or whatnot are going to be affected to you directly because rates are higher than they were. But there's an indirect way where you're going to get affected as well, because corporations they don't have the luxury that they had over the last several years, where they can have access to money at very low interest rates as well. And when they have that, they're able to pass on that cost savings to their consumers. Now you're seeing rates of anywhere from 10 to 15% that many companies, especially the mid to smaller size companies, have to pay in order to borrow and to meet their needs, whether it's acquisition, growth, or whatever they're doing. Indirectly, that ends up affecting people because it shows up in the cost of goods and services, eventually over time, which really changed the dynamic of how companies borrow. A lot of this is now shifted to the private credit market. It's actually something that we've taken advantage with in a lot of our clients' portfolios, where we're introducing private credit as an investment option, because you can actually make really good income off of it.